No cuts expected today. Nobody's expecting a cut today, but everybody's listening for Jay Powell's news conference and also waiting to read the FOMC statement. What are you expecting?
Well, you're exactly right. No change is expected today. But the question on everybody's mind is, when will the Fed start to lower interest rates? And we think that they'll continue to march toward that eventuality by perhaps softening some of the language today, removing a bias, if you will, toward tightening. In December, the Fed chair continued to signal a willingness to tighten. He seemed to suggest the decision set for the Fed was to do nothing, or perhaps maybe raise interest rates if inflation becomes a problem again. I think now what you'll hear is much more balance. The Fed is equally as likely to, or thinks it would be as likely to raise rates as lower rates, and actually continuing to take the steps toward what we think will be, rate cuts in the spring.
I want to make sure I heard you correctly. You said right now you think the Fed's just as likely to raise them as cut them, or is that the message that Jay Powell wants to send?
Exactly.
Okay.
I'm sorry, Frank. What I was just trying to say is I think we'll hear more balance from the Federal Reserve today, actually not talking about or not reminding the markets about the fact they could tighten further, and suggesting a much more neutral posture. And so that is, a step toward the shift fully into thinking, we're going to be cutting rates definitively as our next step.
All right. So the Fed has always said it's data dependent. They're looking at the data. But when we look at the data, inflation is still going down, but it's above the target of 2%. We saw GDP and manufacturing surprise to the upside. So does this data dependent Fed, does it see the soft landing? Does it see everything working out? Or do you think a more restrictive policy is more likely, as New York Fed President John Williams said? He's all about that restrictive policy stance.
Right. Well, I think the Fed has got to be really pleased, to be honest, with the way things are unfolding. We are seeing inflation coming down, as you said. The core PCE deflator, the inflation measure the Fed watches closely, finished 2023 just below 3% at 2.9. And meanwhile, the economy, which has cooled, but it looks like maybe we're going to avoid a recession. We unfortunately think that won't be the case.
Okay.
But for right now, there's more resilience. So it looks like the best of all worlds. The question is, does the Fed need to keep rates as high as they are currently, given the fact that they've got things very much where they want them? It takes a long time for policy to take effect.
Right.
So sitting at 5.5% is still like keeping their foot on the brake. And I think what the Fed is now thinking is just taking their foot off the brake, beginning to cut rates, not to stimulate things, but to just get the level of rates back to more of a neutral posture. Again, it's not that the economy needs to get the gas, but it doesn't need to have the Fed's foot so firmly on the brake.